Good evening, everybody. Thank you very much for joining in. This side, Rahul Magan here as the Chief Executive Officer of Strategy Consulting LLP, which is a limited liability partnership firm in India and having multiple revenue streams. And today we are going to speak about one of our latest series which we are bringing in India for our YouTube subscribers, which is Indian Fiscal Monitor. So every week, which is roughly Saturday, Sunday, or could be the first week of the week, we will bring out Indian Fiscal Monitor to you, and Indian Fiscal Monitor would be covering everything which is pertaining to the Indian domestic market, Indian financial market in short, which is Indian capital markets. Which is Indian fixed income market, which in turn covers debt market, money market, and capital market. So aforesaid, which you see right up front, this is the Indian Fiscal Monitor, which is 25th November 2016, which is very recent, not very old. So if you look at few headlines, which is Indian equity indices ended down because of the selling by the foreign institutional investors. Indian indices are getting down because of the selling by foreign institutional investors. The idea is very clear that because of the reverse carry which is happening in the market, the foreign institutional investors are taking out the money. Now, reverse carry is a phenomena which is very much going to happen in India, because Indian interest rates are getting down, and if we are correct that over the period, Reserve Bank of India will come forward and cut down interest rate by another 50 basis point, probably by January 2017. So in that sense, it would be next to impossible for India to offer the rate which other global economies are offering, like Brazil, your Australia, your US. And also, we should not discount the fact that now, you know, now Federal Reserve is all scheduled to increase the rates, and that is very much imminent. And if Federal Reserve will increase the rate, then things would be a little bit on the wronger side of the game, and people in the United States would be able to invest at the better rate in their country. So why they will go out and invest this? This is called reverse carry phenomena. Now, reverse carry phenomena is happening in India, and henceforth the foreign institutional investors are taking their money out. And according to an estimate by the media and the Bloomberg TV and the variety of business channels, the total money out by foreign institutional investors is approximately $6 billion or so. It excludes the selling which has been done by the domestic institutional investors, because some form of selling which has or which is also been done by a domestic institutional investor. This excludes that. Indian technology is losing the saw. Indian information technology companies are losing the game because, of course, one side the Trump is the president of the US, and second side, a lot of talks are happening about anti-outsourcing talks and so on and so forth. In fact, on the Bloomberg TV, a very good discussion which is happening when Trump is trying to curb the outsourcing which Apple is doing in China, and Trump is saying you should produce in US, but Apple is saying we don't think that US is so prepared that we are able to shift our production from China to US. So a lot of things which are happening across in the Indian. But the most important which we would like to present is this, that our Sensex is now approximately 25,000 something, and Sensex is falling. In the last 1 month, Sensex has fallen by approximately 12,587. Fallen by approximately 8.23%. So that would continue to happen, and that would continue to happen. In my personal view, December is always a month of reverse carry, irrespective of Federal Reserve hike or not. But now, if you take Federal Reserve hike and other things, my personal opinion suggests that Sensex is heading towards 22,000. It could be 23 something, provided if government institutional, domestic institutional investors on the instruction of the government of India will come and save this, then I cannot give any guarantee. But in my personal opinion, they are heading towards approximately 22 or 22 and a half something. Nifty is of course 7,966. Nifty is also falling, and in the last 1 month, Nifty is roughly 9% down. So this is very high, and in my personal opinion, that Bank Nifty and Nifty 50 will surely get down in the near term. On the other hand, these are the two broader indices. On the other hand, other indices you can see here, which is mid cap, small cap, auto, bank, energy, FMCG, metal, pharma, and all. These all are falling. Like if you look at this column, which is 1 month return, you will get to know that these all are falling. And this fall would continue over a period of time, because December is always a month of reverse carry. Yes, I think a sustainable increase in the month of January, because January is a time when people will come and do the carry trades again. But I'm not very bullish on January because there is a reason to it. The bullish is that when Raghuram Rajan was at the helm, he never allowed government to cut repo rate extensively. So he was always very serious about the interest rate should not be cut and so on and so forth. On the other hand, post Urjit Patel, I am not very bullish that Reserve Bank might cut interest rate. Henceforth, as I said, that December is always a month of reverse carry, and and January is always a month when people will invest. I strongly doubt that people would be able to invest further in January, but again, the time will tell. To be very honest, if we go down about this economic indicators, which is Y indicators, which we taken from the market, I do not have trust on any of these indicators. I strongly don't think that the country inflation is 4.2%, which is greater than 15%. I don't think that IIP of the country is growing. I don't think that the country GDP is growing at the rate of 7.10%. I strongly believe that country GDP is growing not more than 4.5%. And any indicator pertaining to inflation, whether it is a CPI, WPI, deflator, which India is not producing, and so on, I never trust on that. So I don't think that India is having an inflation of 4.2% with a GDP of roughly 7.10%. Indian inflation is greater than 15%, and GDP is between 4.5 to 5%. Yes, if you just do the base effect, then you can do anything. Now, if we go down and try and see the financial market indicators, this is very important that we should discuss more about that. Which is that the Indian call money market, which is also Indian call money market, shortly known as MIBOR also, but here it is not as MIBOR. You can see here. Now the call money market is trading at 5.80. All rates are falling. Repo is 6.25. 10-year GSEC is at 6.18, which is very low. All CP rates, 1 month, 3 months, 6 months. CD stands for certificate of deposit. 1 month, 3 months, 6 months. 1 year CD. All rates are falling. If you compare these rates with the 1 month ago, the rates are falling because they already discounted, because they already discounting that the RBI will cut the rate very very soon. And believe me, if RBI will cut the rate, then things would be gone. There is no doubt that India will surely move towards reverse carry. But again, this is out of our jurisdiction. We cannot do so. So, in my personal opinion, in the next by January 2017, this call rate might go to approximately 5.3, 5.4. We will see a 50 basis cut in repo. So from this 6.25, which is a repo rate, we will went down to 5.75. And I think that the 10-year GSEC would be below 6% barrier, and I think it would be roughly 5.90 something, plus minus 10 basis point. And here comes the panic selling, because of course Brazil, Indonesia, Australia, US himself, they are offering much better rate than India. So why I would continue to do a carry trade for on a 10-year GSEC at 5.8% if somebody is offering me 7.7% like Indonesia? As simple as that. Hedging is, of course, if I'm doing my hedging in India, I will do my hedging in Indonesia. So I'm not unhedged either way. So I'm not saying that the counterparty risks do not matter, counterparty risks matter, but in any ways, neither I was unhedged in India, nor I'm going to be unhedged in Indonesia. And I think that with the huge amount of flush of money we have in the banking sector because of the demonetization of the currency, this certificate of deposits rates would continue to grow, or would continue to grow, and I think would continue to down. I think that we will see a substantial fall in the certificate of deposit rate than the so-called CP, but this would surely bound to happen. This would surely bound to happen. These are and this is our yields which we have. 6 months yield, this is government security. 1 year yield, 10-year yield is 6.31. So this 10-year yield is the latest which we are talking about. This 10-year is something different. This is 10-year gilt. This is the latest, and this is a different font we are talking about, but both are of 10 years. So this is AAA bonds, this is AA, and so on. So now I would like to just check one thing, and then we will move forward. We will wind up this Indian History Monitor. If we carefully look at the paragraph which we have here, this paragraph, then you will get to know a fantastic thing, that the credit spreads is also rising. Sorry, my mistake, not the credit spread, the swap spread is also rising. Now what is swap spread? This is a swap spread. A minus GSEC. Government security is 100% credit free. There is no doubt about that. On the other hand, A minus is having some credit implication. So if you look at here, then you will get to know that the credit spread in India is greater than 100 bips or roughly 1%. In all the cases, you come here, this is greater than 100 basis point, greater than 100 basis point here. It is greater than 100 basis point here. It is also greater than, it is for 10 years, this is approximately 200 basis point. We do not have the data for other G6 like 15 year and 20 years, but if you carefully see, then you would get to know that the credit spread between a double A minus bond, double A minus security covering the GSEC of 6 months till 10 years, it is at least 1%. In some cases, it is to 2% also. So it is not that the credit spread has fallen in India, or it is not that the credit worthiness of the Indian companies has substantially increased after demonetization, or the Indian corporate sector is doing well. This particular, I would say, is same. But at the same time, we should also appreciate the fact that over the period of the time, all those people, those who want to come in and do trade in India, especially carry trade, and if you're looking this as an Indian fiscal monitor, then they of course need to take a call, because if my credit spread is 2% for 10 years, then my CVA would be higher. CVA stands for credit valuation adjustment, so that would also be higher. And the higher the CVA, it means the lower the margin for me in India. This is how things would happen, and this is the lower the carry margin for this particular bank or a corporate. This is how things would happen, and with this we would like to appraise you that uh, India would face low interest rate in the near term, but the low interest rate doesn't mean the end of inflation in India, and at the same time low interest rate doesn't mean that the people who are sitting at the grassroots, they are able to get the benefit of this. It effectively means that they might not get the benefit of that, because the transmission mechanism is in India is not very transparent. Transmission mechanism refer to, like, if you cut interest rate by 25 bips, then at the end till the bottom it will come as 25 bips. This was for the day. You are welcome to contact us at 9198999242, rahul.magan@regicosetting.in. And we are very pleased to share that we created our online academy, which is TR Consulting, wherein we are covering online courses using webinar. And you're welcome to join the same. And today we are starting our first batch covering foreign exchange. With this, we will thank you very much and see you soon.